Hi, this is Ben, Senior Trading Mentor here with ITPM. I hope you're all doing well, making money in the markets. Okay, so the on and off tariff development that's been causing the market volatility has kind of subsided, and the market, as far as the S&P 500, is now higher than where it was before this whole mess started in the first place. We are actually within around 5% of all-time highs in S&P. So for the most part, the broader areas of the market has just shrugged this off, and the focus is now back to earnings and what the future will look like. Speaking of that, Nvidia reported last week, delivered pretty solid numbers overall. So quarter to date, out of the S&P 500, 473 companies reported, okay, and 368 of them exceeded EPS consensus. And 87 trailed the consensus, and 18 reported inline results or thereabouts. So the macro data that's also been coming out has been mixed. Now, we did have a weak ISM manufacturing print just this morning, came in at 48.5, which is actually 1 point below the consensus. But the market reaction so far, at least, has been muted. And all eyes are on the Fed meeting coming out later this month, but so far the probability for a rate cut in June is actually very low. So now the rebound that we saw in April and May was actually fairly broad-based. It didn't really start out that way, but then it expanded. It was led by tech, okay, although there were several other sectors that did quite well as well. But tech will be the focus on this idea. And the stock I'm looking at is, as a long idea, is Unity Software. Ticker is U. Last traded at $26. Okay, it's a $10 billion market cap company, and they operate a platform that allows users to create games and other content that they can grow and then monetize. It's pretty neat, actually. And they are the market leader in this space, in this kind of real-time 3D development. And it's really the building block behind more than 50% of mobile games, actually, which was a bit surprising when I saw that, but yeah. And they're also expanding outside of gaming into 3D tech for industries like automotive, architecture, film, obviously, simulation, and healthcare. So this is what the chart looks like over the past few years. And while EPS is still negative, it is improving in the tune of close to 50% for this fiscal year versus last year. And the free cash flow here is kind of a big thing where they have really broken that out and it's doing dramatically better. That plus the margins are expanding as well. Now, as far as valuations for companies that have negative earnings like this, we can look at some other metrics. Price to sales or enterprise value to sales. Enterprise value is just a market cap plus the total debt minus cash, basically. Anyway, in both cases, price to sales and enterprise value to sales are around 6 times, which is, yes, it's fairly high, but it's not crazy high, especially for companies like this, kind of techie companies that are pre-earnings with just massive growth potential. All right, so they reported on May 7th, and they beat revenue estimates by 30 million. And when I was looking into this earnings call, I found several catalysts, but there was one that kind of stuck out, was their AI platform, which they have been talking about upgrading to, their ad-based platform, actually, which they were upgrading to an AI-based platform that they named Vector, happen way ahead of schedule. Okay, so this has already resulted in 15 to 20% rise in iOS users. And that said, that is likely, I mean, we're seeing it already. There have been multiple broker upgrades, but management did acknowledge that we're going to see could see some potential short-term revenue impacts from the mitigation of the legacy products. Okay, so plus that, as far as seeing this showing up in the bottom line or the earnings per share, might take a while to show up. So last week, Jeffries upgraded the company on the back of all this, and we also seen EPS revisions ticking higher, as you can see here. Okay, so how would I structure this for a limited risk, high ROI options trade? They're scheduled to release earnings the first week of August. And I want to have exposure to that. Okay, so in this case, it will be a classic calendar ratio spread. That's what makes the most sense here. And as with all my trades, the options chain is liquid, okay, with reasonable bid-ask spreads for efficient execution. If you try to trade options where you have massive bid-ask spreads, you just make it more difficult for yourself. Anyway, going long 20 of the August 28 strike calls at 320 will cost you $6,400. And then simultaneously adding a short leg where you sell 10, since the ratio, so you sell half. Oh, the July 30 strike calls at 180. It gives a credit of $1,800. That's how we set this up. Right now, the total calls for that would be $4,600. And we're looking at this within the context of a $100,000 portfolio, basically. This is now set up with limited risk and unlimited profit potential, which is what we like to see. And if the stock stays below the short strike of 30, which is the recent resistance, until the July expiration, then we'll capture the full credit of $1,800. And then that, if you look a little bit further out in time, especially towards earnings, the high end of the range from last year and also 2023 was a bit over 40, a couple of points over 40. Okay, so I think it's feasible for the stock to get back up there later this year, especially over the next earnings release. So in that case, let's say the stock gets to 40, okay, in August, the long leg will have a profit of $17,600. Okay, so that would be 40 minus the 28 strike minus the 320 cost times the 20, which is the size. And if you then add that to the $1,800 profit on the short leg, we have a total P&L of $19,400 in this case. And that's a 4-to-1 reward risk. So that's pretty nice. All you need is, like, you get one of these right, it more than makes up for several losing trades. Anyway, there are many ways that this can play out. Obviously, stock could go a lot higher than 40, or might not even move at all. But let's presume it rips before August. Like, so by July it gets to 40. Well, then what? Well, now you have a loss on the short leg because it's in the money. But since we net long 10 calls, plus the August calls are further in the money and they have time value left since they expire in August, the total P&L for that trade in that case, if the stock just rips right away to 40, will be over $11,000. It will be a loss, okay, if the stock stays below 28 till August, and we just take no action to remedy that. But the max loss is the cost of $4,600. All right then, so I like this one a lot. That's all I got for today. Catch you next time.